What you're about to hear is how capital moves before it hits crypto. Wall Street is already adjusting. The question is, are you paying attention early enough?
They will say the ever bullish Tom Lee was ever bullish, but you were also right. I mean, is there anything that is going to stop stocks right now, Tom? Because they just keep going up.
Hi, Brian. How are you? Well, I think stocks are holding up because the economy's actually doing better in the face of this war. And I know it sounds counterintuitive, but part of it is the defense spending, at $30 billion a month, and it may end up being, $60 billion a month. That's actually quite stimulative to the economy. This $20 rise in oil is only adding about $12 billion a month to the household burden. So on sort of net basis, the war is actually helping earnings right now.
Yeah, and it's hard to admit this because I do know that gasoline prices for a lot of families out there are a major cost, especially with all the other inflation in the last 5 years. But with car mileage per gallon up, if you do the math, you're looking at maybe $50 to $100 per family per month in extra cost right now. Again, it's not insignificant. I want to be mindful of that. But it sounds like you're saying that is not enough to damage the economy and thus damage corporate earnings and the markets.
That's right, Brian. I mean, nobody wants the U.S. to be at war.
No.
And of course, we're caught in a fog of war. I do think one of the things we have to remember, even like going back to World War II, the stock market bottomed in May 1942, 5 months after the U.S. entered the war, but before any U.S. troops were even on the ground, either in the Pacific or in Europe. So the market does have a really good way of sort of discounting outcomes. And I think the reason it's going up is I think we're going to end up with a favorable outcome, which I can't say I know why, but that's what it looks like.
Most people hear that and think it's just another stock market conversation. It's not. What you just heard is how institutional capital thinks, and more importantly, how it moves under pressure. Notice the pattern: war, uncertainty, rising oil, inflation fears, and yet markets are holding up. That's not random. That's capital positioning ahead of resolution, because markets don't wait for clarity. They price in probability. And when Tom Lee says the market is already discounting outcomes, that's your signal. Because if equities are stabilizing during macro chaos, that means liquidity is still flowing. And where does that liquidity go next? Higher beta assets, higher volatility plays, asymmetric opportunities, crypto, Bitcoin. This is the same pipeline we've seen before. Liquidity enters equities, then rotates into tech, then explodes into crypto. And right now, we are somewhere between stage 1 and stage 2, which means most people are still too early to feel comfortable, but already late if they're waiting for confirmation. And here's the critical insight. Markets don't crash when fear is high. They crash when complacency is high. Right now, we're still in uncertainty, which means positioning is still being built, quietly, systematically, relentlessly. So the real question becomes, if the bottom is forming in equities, what happens when capital rotates into crypto?
On the macro, let me explain why I believe the bottom likely is in. I know we're in the fog of war, but keep in mind, stocks, since there have been 8 major conflicts in the last 125 years, including this Iran war, and stocks bottomed 10% into the duration of the war. Think about that. Only 1/10 into the progress of a war, even before troops are committed, stocks typically bottom. This was true of World War II. The U.S. entered the war on December 8, 1941. The Dow Jones bottomed 5 months into World War II, even though the total war lasted 45 months. We could see it on time series here. This is when the U.S. entered World War II. The equity markets bottomed 5 months later in May 1942. And June 1942 was the first real battle of Midway. 1 month later, and the and the Dow was already rallying. The US didn't enter Europe until D-Day, June 1944. That's a full 2 years later. And as you can see, the market went up after the invasion. So knowing this fog of war, let's go back to today. There's 3 reasons I think the stock market bottomed. The first happened because the stock market began to rise while oil rose. The equity markets and oil have had an inverse correlation, and it got to an extreme inverse correlation recently, the highest in a year, meaning as oil went up, equities went down. And we could see the inverse relationship at play since the war started. Whenever oil went up, stocks went down. Conversely, once oil went down, stocks went up, and this continued. But then there was a pivot at the end of March, and that pivot was that oil went up, and yet the S&P rose 5%. And then the second thing happened earlier this week, which is we had less bad news. The ceasefire is not an end to the war, but it's the beginning of the end of the war. And I know it sounds strange, but it's a rate of change observation. When less bad happens, that's considered good. And as you can see, as soon as we got signs that the war was de-escalating, oil fell 20% and the S&P rose. And the third sign arose today, which is the end of on April 9th. And that's because the VIX had closed above 30 and then fell and closed below 20. It's a sign that the idea of seeking risk protection had already peaked. We can see that on this time series. Shortly after the war started, the VIX jumped to 35 and it closed above 30 at the end of March. And then this past week, it closed below 20, the first time since the war started, or it's back to pre-war levels. Since 1990, there have been 4 times where the VIX moved above 30, then oil had a big decline, and then the VIX closed below 20. And here's the thing. The median 6-month return is 9% after closing below 20. That implies the S&P can get to 7,400, which is more than an all-time high. So nobody rings the bell at the bottom, but I believe the bottom is in. And in terms of leadership, we've talked about this in other videos, but since the war started, crypto, including Ethereum and Bitcoin, have been the best performing asset, dramatically outperforming gold. Then it's energy, and then tech. And tech outperforms because people, when they worry about growth, global growth, they buy growth stocks.
Now step back and look at the full picture. We have 2 signals from 2 different angles. First, CNBC interview. Markets are stable, despite macro chaos. Second, fund manager data. The bottom is likely already IN. That combination is extremely rare because it means the downside is getting absorbed, while the upside is being prepared. And then there's the part most people missed. Crypto is already outperforming. Not later, now. That's not hype, that's rotation. Capital is already testing the waters, and once that rotation accelerates, it doesn't move slowly, it cascades. Because crypto is not like equities. It's thinner, faster, more reflexive. Which means when demand increases, price doesn't climb, it spikes violently. And here's where it gets dangerous for most people. They're waiting for confirmation. But confirmation is where the move is already halfway done. The real money is made in the uncertainty phase, where things feel unclear, but the data is screaming direction. And right now, the data is clear. Markets are stabilizing. Volatility is dropping. Liquidity is returning. Crypto is leading. That is not random alignment. That is a setup. And setups like this only happen a few times per cycle. So don't ask, is it safe? Ask, is the structure forming? Because once structure turns into momentum, momentum turns into FOMO. And FOMO is where retail finally shows up at the top. So if you're watching this right now, you're early enough to understand, but not so early that it's invisible. This is the transition zone, and transitions create the biggest opportunities. If you want real alpha, not recycled narratives, subscribe. Because what's coming next is not just a move, it's a rotation. And rotations create wealth.